All right, we're live. We'll call this November 15th, 2022 meeting of Lawrence County Retirement Board to order. Would all please rise for the pledge of allegiance followed by a brief moment of silence. Vanessa, would you lead us in the pledge?
I pledge
Allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Please remain standing for a brief moment of silence. Thank you. Vanessa's getting used to it. Please call the roll.
Treasurer Rapone,
Present.
Controller Prestipine,
Here.
Commissioner Spielvogel,
Here.
Commissioner Vogler,
Here.
Commissioner Boyd.
Here. Any public comments? Seeing none, we have minutes from August 16th, 2022. I'll give my colleagues a minute to check those over. Then, take a motion to accept and file the minutes or make any changes necessary to be.
So moved.
Motion Spielvogel,
Second.
second Vogler.
I got a question. This here about changing the assumed rate. It says it was all to take it on. That's why I should read it. I'm good.
Okay. I guess, yeah, that would be on the table, and so we'll move that on. So what was that, the assumed rate? Is that the 7 to 6.75? Yes. All right, so we'll move that to table and we can deal with that in the order that we need to deal with. All right, we have a motion second. Any further discussion here? Not question, unless there's any further discussion. Question on the motion, all in favor, please signify by saying aye.
Aye.
All opposed, same sign. Motion carries. We have our investment consultant with us today, Sarah Wilson. Sarah, how you doing?
Good.
Good?
Nice to see everybody.
Good to see you
Yes.
too. The floor is yours. How are our stocks?
Well, we'll talk a little bit about last quarter because we have to review that. It does get better, but it was a little bit ugly. But I think, we just need to understand a little bit of where the market's going. And I can tell you as of close, you're back up to about 89 million. So when we look at this, we just have to know there is some growth. And you're also diversified and have prepared for this. So we just gotta get through the bump. If we go to Exhibit 2, tab 2, we look at what happened in the quarter on page 10, and we look at what happened with US real GDP growth, forecasting growth of 1.6. A large contribution by net exports likely drove the bulk of economic growth, offsetting a slowdown in consumer spending. And we look and we see how that went year over year, and you can see quarterly, and look at where we're looking at the first quarter 2022, we were kind of negative. And we keep on looking at those kind of on what's happening with real GDP growth. And we also, that kind of comes back into what's been happening with the economy. We look at what's happened with inflation. We talk about recessions. And interestingly enough, the Conference Board's U.S. Leading Economic Indicators Index has declined 2.7 over the previous 6 months. A decline of this magnitude has consistently signaled a pending economic recession, and that's that chart below. And, we have seen inflation is starting to come down. We've had some good reports on that, but we also have seen that the American spender, it is becoming very expensive. So we see, the Fed keeps on trying to curb inflation, but when is that American consumer going to really feel it's starting to come down less, $5.99 a pound? So we're going to see that, and that is going to look at, and we have to sit back and remember that once we start getting all those retail, Christmas is coming up, all the shopping, we're going to see what's going to happen in January and February. The market, while it was in double digits negative, we know in June, that was historically one of the first times, again, double digits at the end of the third quarter. And while that has been down, one of the things that has kind of carried it, so it hasn't really gone off the edge, has been that you had a lot of good corporate earnings this year. So it kind of held it up a little bit, even while we see, double negatives down. That did hold it up. When we look at the U.S. economy, we talk about the Fed hikes. We know we built in, we've had those Fed hikes. We know we've got December. Now, what's happened was CPI in October was 4%. And year over year, it was at 7.7. That just came out. That was one of the drivers in the last couple of days. We've seen the market surge. You know, Friday had the best performing 1,200 points on Thursday. You know, and then CPI is down now. In September was 8.2. Remember, in July it came, it was 9.1 year over year, and that just crushed the market. So we've had a lot of up and downs with that. So you could say these interest rate hikes are starting, you know, to have an effect. One of the questions about the interest rate hikes is, you know, they lowered it so fast, they're hiking it up. And then where are they going to find a happy medium next year? And it was interesting. One of the economists said, remember how they used to lower it or raise it by 25 basis points? Well, the new 25 basis points is like 75 basis points. So they're moving a lot more differently than we look at what happened for produce. Price rose only 0.4% instead of at 0.2% instead of the estimate of 0.4. So the market's kind of liking that. So we started to see the market a little bit rebounding. We look at the bottom there, and remember we talked about the savings rate and that the consumer was starting to save, and you can see that spike. Well, first of all, there was nowhere to spend money, COVID lockdown, except to get online. And then they had a lot of the stimulus, they saved that, and then they started to put it. And now we see, look at that, what's happened, it has really dropped. Well, we know when the interest rates go up, car payments go up. We've also seen this real estate market. And, you know, with interest rates right now, is I think the 30 years a little bit over 8%. Probably some of us on this board have paid that when we have had, and then you just refinance it. But the market values have not corrected itself. You know, so if interest rates are really high, market values go down. We were at an all-time market high for pricing. So that's going to be hard, and it's going to be a lot harder that we're going to see the young buyer be able to go in and buy new homes. We turn to the next page and we talk about what's been happening in inflation across the world. So it's not just us, everybody. We have seen a real issue with inflation data in Europe, in the UK. The UK's had a very interesting thing. You know, Prime Minister, now, you know, she stepped down. At one point, it was that it cost the average person, because they have a control on heating, $6,500 a year. They went and the government stepped in and said it was going to go to $2,750, and that's a year pounds. So, I mean, they've had huge amount of inflation there. And we look at what's happened, and then we look at the 10-year government bond rates in Germany and the UK, for example, ended the quarter near their highest levels in more than a year. We talk about global equities, and we'll look at that in reference to Europe. So the emerging market equities have had a large time. We know that usually global equities, international equities, if you've got an active manager, they kind of tend to do best in a down market because they're a little bit more conservative. We have seen it again, especially in this quarter, growth outperformed value. Normally, we don't usually see that in a down or turbulent market. And the reason is that managers are looking for any kind of gain in the portfolio. They're also saying, look, it's eventually going to go up. So the growth actually outperformed value there. And you can see, look at U.S. equities for the quarter on page 13. Year to date, they're down 17.6. International's down 25, emerging's down 28, international bonds are down 28%, and we still have US bonds down 14.6. So it has been the worst performing bond year since the aggregate index started in the 1970s. We turn the page and we look at page 14. We look at, you can just see the only sector that was up, not surprising. Well, consumer discretionary was up, but the third quarter down for year to date. And then we look at energy was up 3.3, and it has for the years up 43.5%. And then the one thing I did talk about, remember, is on, we look at earnings and we look at recession. So on that thing, According to fact, 240 companies in the S&P 500 cited the term recession during their earnings call for the second quarter, marking the highest number going back to at least 2010, i.e. eclipsing the levels seen amid the pandemic. So what that means is that you're starting to see that earnings next year is going to be a little bit tough. But we've got the Fed not on this great hike, and we've kind of controlled that. We are still going to probably see some turbulent times next year in the market, but hopefully the volatility will not be, down 10, up 10. It will just kind of not go as much. And then we look at earning contractions, economic recessions. If you look at that below, you can see February to April, you had 2 months of contractions, quarters of the earnings decline were 4 quarters of that, and they were down 32.5, and that was those 4 days of COVID. So we do look at that, and we know that there has been, and we are basically in a recession. We say the market, sometimes it's been so volatile and everything, and I think that we'll really see the impact probably next year. But we're already starting to see that inflation through the Fed making these hikes is starting to have a little bit on the numbers coming down and kind of controlling inflation. But you don't want them to keep going up and then all of a sudden they're going to start going down again, because that really kind of drives the market. And when we look at the comments from the Fed on what they're going to do, they're still pretty aggressive. And remember when the Fed came out last and the last interest rates, the market had built it in, and then the market went down because they said, we're just going to keep going. So you don't want an overly aggressive Fed. You kind of want them to kind of find some kind of stabilization there. Are there any questions on the market? All right, let's talk a little bit, go to the next tab, and we'll talk a little bit what you've done. So you ended the third quarter at 83.3 million. You are now, as of close of business last Friday, you're at 89.16. So you've had some bump back. It was a tough quarter. You were right on there. I want to take you to your year to date though. You are down 17%. Your benchmark was down 18.5. So you have outperformed. You've done what you've done. You've diversified and you've done well. In the trailing 12 months, you've done negative 12.3 versus negative 14.1. And we look at your annualized, and since we've been here, you've annualized at 6.1 versus 6.2. You're right on your benchmark. And that is one good thing about bringing down that assumed rate of return, the 6.75. So, this is taken into account that 6.1. If we start seeing the market go back up, that's going to look a little bit better for you. But we had said that hitting that 7.5 is going to be really hard. You need to diversify, and by lowering that, that's a good thing. Now, your year to date now through 10/31, and it doesn't have the real estate numbers in there, is down 13.8. So very different from being down 17%. So you've gained about 4% back. Are there any questions on that? So let's just go to performance. We'll talk a little bit, page 30. We'll just look at how some of your managers did. Again, we know that emerging managers, international managers struggled. Remember, they've had the Ukraine crisis. We've had China's underperformance. China is just starting to let up on some of their COVID restrictions. So that had a huge issue on that. China's the largest exposure to the emerging market index at 31%. So, managers had a hard time with that. And we know that growth and quality underperforming the benchmark. So they had a little bit of growth outperforming and quality was underperforming. So we look there, and your total equity composite for year to date was down 23 versus 25. We look at your managers, Eaton Vance, for the quarter was right on the benchmark. Year to date, it was only down 18.3 versus 24. And since we've put them in, they've annualized 10.5 versus 7.1. So that's been a very nice active manager in that US equity. So we're very happy with them. We look at global. Global, as I talked, was a little bit off the quarter, down 7.1 versus 6.6. Dodge and Cox struggled a little bit. They are a value manager, value to underperform for the quarter. But year to date, they're down 16.8 versus 19.1. Artisan was down for the quarter, only 4.1 versus 5.9. And then MFS Low Volatility has done very well for you. They've been in September 2014. They've annualized 6.3 versus 5.8. So some quarters they're going to do well, some quarters they're not, and we look at the long term when we look at those managers. If we turn the page to page 31, we look at your non-US equity composite. We know they've struggled. We are still happy with Hartford Schroeder. They just had a little bit of some struggling with some of their stock picks. But we look at their 3-year, they're only down 0.9 versus 0.21 negative. So for 3 years, I think it's interesting that international stocks at that time frame from 9:30 have really, really struggled in the last couple of years. But you still want to have exposure to them because as we talked about, emerging markets, the first to go down, and they're the first to go back up there. We did make some changes, as you can see. We added Harding Lover and Wellington Emerging Markets Opportunity. We like them for long term, and Harding Lover outperformed for 3 months versus 6.5 versus negative 8.0. Wellington Emerging Market Opportunities, we don't expect them to outperform in the down market. They're going to be our alpha. We expect them to perform in the up market. So you always have to have some protection, but you also have to have some growth as well. Infrastructure Composite, we've had them in. JP Morgan, we were waiting for where they were CPI +3, but since April, they've done 1.7 versus CPI 0%. That so you've actually had a positive return. It did make sense. It's small, but it does help. We turn the page and we look at defensive equity. Has done fairly well for you, and they were only down 4.1. Year to date, they were down 15. Remember that the equity market was down 25, so we're just getting a little diversification there. On the C.S. McKee, since we put C.S. McKee in there, that's your active manager for 3 months is down 4.4 versus 4.8. Since we put them in, they're down 5.7 versus 6.2. So they have done well. They're a Pennsylvania-based firm. We like them. They're also have been doing very well in fixed income. And you had gotten to the point in May. I would suggest you go into an active manager for fixed income. So I think you're going to be well positioned fixed income going forward. We look at Lord Abbett, you've got a tiny percentage there. At one point, we thought we were going to go back into high yield. You know, we can do that in your investment policy. We almost did it, and then we've had such a change in that market that we've just held off on that for that. But we do look at it all the time. Are there any questions on performance? And, you know, with all, even going with active managers and everything else, still have you in for 35 basis points for all your managers. So that's a nice management fee. Concerning you've got infrastructure, we've got real estate, you know, there. One of the things that I also brought that you've got in front of, are there any questions about the quarterly report? You can jump back if you think about it. Just real quick, the Pennsylvania County database, you know, we do that every year.
This is the proprietary one. In other words, when we give these documents out, the report already asked for a copy of the packets.
You don't, this is, yeah,
This is,
we, yes.
I just wanted to make sure so I didn't hand her both and I was only supposed to hand her one.
I mean, it's part of that. We kind of, it's up to you. We kind of think that it's kind of proprietary towards you, but it's, you know, Out of 62 eligible Pennsylvania counties, 53 participated at an 85 participation rate this year. Now, this is interesting. We're going to look at 2021 for a year. So when we look at those results and everything, and you look at where you are, you kind of feel good. This year, when we go do it next year, I think you're going to see that you're really in the top percentile of counties. When we look at your performance, you have really we'll see that diversification go in there. So let's just look at, I just want to take you quickly, and we can delve into this, but I think page 7 really speaks to how well you have done. You're gonna be at 6.75, the average AR is now 7.17, down from last year's 7.2. I mean, we have gone and worked with all of our counties, keep on saying lowering and lowering. We know that for some counties, that's very hard. And then we look at what's happened with ADC. Look, last year, 19 continuous counties have reported, that's page 6, that's approximately unchanged since 2013, the ADC. That's gonna be a different issue next year. We know once we look at next year with it being down, but you're overfunded, so you're in a nice position. You are gonna see a jump in that ADC payment. There's nothing you can do about it, but you could see a lot worse. So we know that. And we know that following the 2008 stock market crash, the average ADC jumped from 119% to 4.1 million. So we know that we're going to have the markets rebounded strongly and continue to increase through 2012. And this was due to the smoothing effect of 2008. And then they dropped over the next 2 years and have remained flat since, because you've had some great performance in the markets. You've had, just broadly speaking, when we look at that, and you also in 2018, you were positive when the market was down. I remember that. Is that it was flat. So what that has meant is you've done all the right things. You're funded, everything. Next year, you're going to have to be a little bit more prepared, but you're in a lot better situation than a lot of other counties there. And we look at, you did an award, ACOLA. We actually did last year have 5 of the 53 participating counties awarded ACOLA. This year, I think that's going to look very differently because it goes off of inflation and it's just too much for counties. And then we go look at returns, page 13, and you look at the 5-year return. You're right there in the number of counties at 11.5 to average 12.5. You do have a few counties ahead, but those are larger counties. And I can tell you right now that are in hedge funds. They do a lot more aggressive for where you are. You're diversified perfectly, and you can't take too much risk. So, but you are way ahead of, a lot of other counties. And we look at the 10-year, you're right there as well. And then we look, and we just broke them out there, 2020 returns. And we've always said that, and I think that if you look at 2020, and then you see the jump in 2021, that's when we added some more diversification to the portfolio. So it's been continually doing well. We've been doing well among your peers. And then we look at the adjusted funded rate, and you can see you're actually at one of the tops. You've done very well. The average adjusted funded rate across participating counties as of 2021 was actually 100.3%, because they've lowered we've seen a lot of counties, we've seen our clients lower that, and you've had some good market returns. That will probably look very different next year. Read it if you have any questions. I mean, we do it every year. There's really, I think, since to come out every quarter and everything, but it is something that's
I have one. Our projected salary increase assumption right now is 3.5%. We're a percentage point under that. in terms of what we're doing right now in terms of budget. I mean, most of our salary increases are 2.25% right now for our union contracts. What would lowering that to 3.25 do in terms of our contribution?
As an actuary, that would be Korn Ferry.
Do you think it would be significant, Dave?
Whether it be significant, but probably, I would think it would be lower, I don't know about how much.
Would you be able to ask that question?
You're right, I don't think it's gonna be that much on the impact of
Okay.
that. That contribution is something that, we have other counties that we've seen, not our client, that have actually taken out a bond issue to pay for it. I mean, you see, we have counties that can't make the whole contribution and then we'll give COLAs out. I mean, there is, it's a hard thing, and then you see counties, that, during an election year get pressure on, to give COLAs or to do this. So you see a whole dynamic of that, and it's just gonna be hard, that is one of the things about having a pension fund, is that ADC, but you've made it, and you keep making that contribution, and that's really important, because we're not gonna be here, but the effect of not continuously not
Mhm.
making
You
it,
have to make
at one point, you're gonna see some counties that are gonna be like, we gotta figure out what we're gonna do. Are we gonna start paying Benny payments out of the general fund, because that's gone down so much? So that won't, when we're all here, but I mean, long-term, it's painful, but it's needed, because you do offer that. And as fiduciaries.
Any questions for Sarah?
No.
All right, thank you, Sarah, appreciate it as always.
Yeah.
Up next, we're gonna take these a little bit out of order, these resolutions, just as we do have one table. So the first one we're gonna take is the resolution to discuss possible approval for a 3% monthly contract increase for Korn Ferry. That contract amount is they just checked, is what, $69 a month? And that's paid for out of the retirement fund. Any questions, comments on that? And that will be resolution 2022-2.
Number 2.
2022-2.
-2.
Board slightly less productive than the Board of Commissioners. At least it's from a resolution perspective. I'll take a motion on that.
I'll motion.
Second.
Motion Prestipine, second Rapone. Any further discussion on that? Hearing none, question on the motion, Vanessa, please call the roll.
Excuse me, Treasurer Rapone,
Yes.
Controller Prestipine,
Yes.
Commissioner Spielvogel,
Yes.
Commissioner Vogler,
Yes.
Commissioner Boyd.
Yes.
Motion carries.
Thank you. Up next, resolution 2022-3. Rate of interest to be credited to member accounts for fiscal year 2023 is set at X%, set as effective January 1, 2023. Dave, what are you thinking here?
It's currently at 4.25.
Do we want to leave it at 4.25?
That would be my suggestion. If anybody else has any comments on that?
Any objection to moving it up or down from 4.25? All right, I'll take a motion. I guess we'll just fill in 4.25. And then I'll take a motion for resolution 3.
So moved. Second.
We have a motion, Spielvogel, second Rapone at 4.25. Question on the motion, Vanessa, please call the roll.
Treasurer Rapone,
Yes.
Controller Prestipine,
Yes.
Commissioner Spielvogel,
Yes.
Commissioner Vogler,
Yes.
Commissioner Boyd.
Yes.
Motion carries.
Thank you, and this will be 4. We're gonna take it off the table first, because I believe we did table it last time. And so I'll take a motion to remove 2022-4 from the table.
I'll move, just not to get too technical, when we tabled it, was it assigned a number?
Yeah, that was number 1.
Oh, okay. Thank you, Dan, appreciate that.
Okay.
So we remove number 1 from
I'll
the
still
table.
move to
There we go.
table, to remove from the table.
We have a second?
I'll second.
Motion Vogler, second Prestipine. All in favor, please signify by saying aye.
Aye.
All opposed, same sign, motion carries. This, we've discussed at this point internally, ad nauseum. Are there any questions regarding, dropping the, assumed rate of investment from 7 to 6.75? Again, that's reflecting the R word that Sarah used a couple times during the presentation, I believe, the recession. All right, I'll take a motion to approve, number one.
All motion.
Second.
Motion Press, second Rapone. Any further discussion? Hearing none, question on the motion, Vanessa, please call the roll.
Treasurer Rapone,
Yes.
Controller Prestipine,
Yes.
Commissioner Steelvogel.
Yes.
Commissioner Vogler,
Yes.
Commissioner Boyd,
Yes.
motion carries.
Thank you. Dave, if you'd be able to have Korn Ferry rerun their actuarial figures based on our significantly improved financial position from last time around, hopefully we'll be able to get that payment down under $1 million.
Yeah, I'll talk, he had said that too. Once we get further into the quarter, to let them know, we'll see what the results of the market were, maybe that could change a number. I'll talk.
When did the market snapshot it?
At that time, it was September 30th, is when they gave us the first application.
31.
What's that?
Can you move it from September to snapshot it?
For
Or
an estimate, yeah.
Yeah.
So that's what we'll do, is try to get that number. You know, every dollar counts at this point. Budget's tight, budget's very, very tight. Any additional business for members of the board?
only things I know, we publish next year's, and I came back, so May, we need to pick a date. Because I can't do the May. For the retirement board meeting. Do you publish those at the beginning of the year or?
We will usually publish those in December.
So we have to change.
You have to change May.
What works for you, sir?
No, it's only what works for you, I just, there's
We're far enough out that
And you're being selfish leaving, so.
I know.
I had to throw that in.
It is one of the first times I'm this like, so we're looking at May. The problem is you've also got the primary for 8,
Yes.
which is the 9th.
No, to be the third Tuesday.
Oh, so it's the 16th,
Sir, when are you leaving?
I think the 18th.
The 18th. Let's,
The primary is the 16th.
yeah, will you be back by the 30th?
Yeah.
She's not coming.
I said, did you just, yes, I
I'm like,
said,
yeah,
just a cruise around the world, you're not coming back.
God, will you be back by June 6th?
yes, I'm back by June 6th. It's just the way I've marked it. We're trying to figure it out.
You're fine.
No, do what you need to do, we'll
It's,
work around it.
Is the board good with June 6th? Is I don't want to push it to before the primary, just because we're going to be pretty swamped. Is everybody all right with
Fine with that.
June 6th?
June 6th.
okay. I mean, you do get weekly updates and I'll be out here, but if there's a concerns, you know, I can touch. So is that better
Yeah,
this
we're
too?
gonna go.
Okay.
Don't worry about that guy from Perry Township too. I hear he's back. All right, we'll make it June 6th then.
Okay.
No issue there. We can
Thank you
adjust.
very much.
Yeah, no problem. Yeah, with that, unless there's any further comments, I will adjourn the Lawrence County Retirement Board.
Thank you.
He's great.
Good meeting.
He's a great person.
Everybody have a happy Thanksgiving.
You too.
Yes.
She's the tax collector, which is good. Tell you what, every township should have somebody. Some do, but.
You didn't have one for weeks.
How many are eating?
I know.
I'll have 16.
Okay.
So I mean,